There's one loss that hurts worse than missing a big move. You spot a familiar candlestick pattern, you think you know what it means, you enter with confidence, then the market reverses hard against you. That doesn't happen because the pattern lied or you studied the wrong thing. It happens because you read the shape but missed how committed the control shift actually was. In part 1, we spoke about 5 patterns in the framework for reading them. Today in part 2, we are breaking down 5 more critical candlesticks patterns like the bearish ones and the multi-candle setups that consistently trap traders. By the end of this video, you won't just be spotting patterns, you'd be reading the real intent behind them to build your Olymptrade strategy. Make sure you stay for the last one, the Doji. It looks simple, but it fools more traders than any other. So if you're ready as I am, give this video a like and let's dive in. And don't forget to let me know in the comment section which other patterns you'd like me to cover. In part 1, the question was, who is in control and is that changing? Now let's add a second layer to that question. How committed is that change? Because most markets don't just shift, they shift with varying levels of conviction. A strong shift looks different from a weak one, and misreading the strength of a shift is precisely where most of the bad trades come from. A weak shift can look identical to a strong one if you are looking at the shape. Context, location, and the candle after the pattern are the 3 things that reveal strength. Keep them all in mind. The bearish engulfing is the mirror of the bullish engulfing we spoke about in part 1. A green candle closes, then a larger red opens higher and fully swallows the green one closing below its open. Basically, what it means is that sellers stepped in with more force than buyers had originally shown. But location is what determines whether any of this really matters. If price stalls or pushes back, the engulfing was just noise. Strong location plus follow through are what makes this one of the better bearish patterns. If it forms in consolidation or at a random price point with no context, it's weak. And once again, the next candle is your truth test. Did the next candle close lower? If yes, then sellers are flowing through. Did it stall, push back, or erase the red candle? If so, the engulfing failed. Strong location, strong follow through, that's when this pattern ends a trade. The shooting star is a single candle with a small body near the bottom and a long upper wick reaching above it, sometimes 2 to 3 times longer than the body. Here's the story the candlestick pattern tells. Price tried to rally during the session, but sellers slammed it all the way back down, rejecting the highs that buyers tested, higher prices, and got crushed. The wick tells you that higher prices were tested and rejected, but a rejection alone doesn't tell you where price is going next. What makes the shooting star significant is where the rejection happened. If the upper wick reached a prior resistance zone, a level that held strong before and got pushed back, that means it's meaningful. The rejection defended itself. If the wick formed above and open in a space with no historical significance at a price, then you are looking at normal price noise with an impressive shape. Wait for the next candle. If it closes lower and moves with conviction, that means the rejection is holding. If it closes back near the wick's high, sellers didn't actually follow through. The morning star is a 3-candle reversal pattern, one of the more powerful ones when it's real. Here's the structure. First, a strong red candle, sellers in full control. Second, a small candle, red or green, it doesn't really matter. Small body represents indecision. Next, a strong green candle that pushes back into the body of the first red candle. Ask yourself this, who is in control and how committed is the shift? The 3 candles tells a complete story. Sellers were dominant, then momentum stalled and the market became uncertain. Then buyers stepped in with real force and reclaimed ground. Most traders focus heavily on the middle candle, the small indecisive one. They see the pause and think the sellers are stopping, so I should enter. But markets don't reverse on hesitation, they reverse on commitment. That commitment alone shows you the 3rd candle. How large is it? How deep does it push back into the first red candle? If the 3rd candle is strong and closes in the midpoint of the red candle, that represents conviction. If it's a moderate green candle and barely moves into the red one, that's a weak signal. Wait for the 3rd candle to prove itself before you act. The middle candle is context, but the 3rd candle is your signal. The evening star is the bearish mirror of the morning star. 3 candles, opposite direction. A strong green candle, then a small indecision candle, then a red candle pushing back down. This is one of the most misread patterns for one specific reason. Traders see the shape and expect a large drop, but the strength of the signal depends entirely on how much ground that 3rd red candle reclaims. Here's the measuring trick I want you to remember. The 3rd red candle needs to push deep into the body of the first green candle. If it closes below midpoint of the 3rd green candle, sellers are showing real conviction. Think of it this way. If sellers showed up with an evening star but couldn't reclaim meaningful ground, they are actually not in real control. They just made noise. So after the 3 candles form, measure the depth of the 3rd candle. Deep push equates stronger signal. Shallow push means proceed with caution or wait. The doji is the most important pattern we are covering here and the most misused. Here's what it looks like. The open and close are nearly at the same price. There are wicks above and below, sometimes long, sometimes short, but the body of the candle itself is tiny and almost non-existent. Price battled up and down during the session but ended right where it started. Nobody won. It's pure indecision and balance. Here's the trap most traders fall into, and it's a big one. They see a doji and immediately try to predict which direction the break will go. They enter before the break even happens. A doji is not a call to action. It's rather a call to wait. What the doji actually tells you is that the market is pausing and hasn't decided. What comes after the information is actually what you are looking for. If a strong candle breaks into the upside of a doji, it means buyers have the upper hand. If a strong candle breaks into the downside, sellers are gaining ground. The doji is the break before the answer. Let the answer come before you trade. So what now? You have 10 patterns and 1 framework. If you try to practice all 10 at once, it will quickly get overwhelming. So here's what I want you to do instead. Watch this video if you haven't seen it, the link is in the description. And pick 1 pattern from part 1 and 1 from this video. Just 2 and stick with these 2 for the next week of chart review. On your chart, find each pattern and mark it. Then before you scroll forward, take note of the following. What was the context in which the pattern formed? Is the location meaningful or random? And how committed does the signal look? Then look at the next candle, not 10 candles, just 1. You'll quickly start noticing that setups with strong context and good location behave differently from the ones without. That's not luck, that's pattern recognition built the right way through observation and repetition, not just memorization. If you made it here, you now have a more structured way to read price action than most traders who have been doing this for years. Leave a like if this helped, as it genuinely helped the content reach more people. Tell me in the comments which pattern from either video you are going to focus on first. If you want to take the next logical step, combining this pattern with indicators that actually confirm what you are seeing on the chart, then the next video about 5 indicators that actually make money in 2026 is exactly where to go. That's where pattern reading and indicator confirmation come together, and that combination is where real consistency starts to form. See you there.
Olymptrade. Care that counts.